Well, from return to office to some deal action, there are a few trends that are providing a boost to the real estate investment trust sector. Joining us now to discuss is Sam Damiani, Managing Director for Equity Research with TD Cowen. And for full disclosure on companies covered by TD Cowen, a division of TD Securities, please see the link to the website at the end of this video. And Sam, thanks very much for joining the show.
Pleasure, Anthony. Always good to be back.
All right, we're in the deep into earnings season right now. What are some of your overall earnings growth expectations for REITs?
Yeah, so tonight we have some big names reporting, really getting into the thick of things in terms of REIT earnings for Q2. And we're looking for relatively modest growth this quarter, 2%, which is kind of in line with what we're looking for the year. Over the last 2 or 3 years, REIT earnings have been accelerating as they've been sort of getting used to the higher interest rate environment that started back in 2022. But this year, it's a bit of a pause just because of some big names in the sector like RioCan, like CapREIT. They're doing some heavy capital recycling, and so just some timing issues have caused on bottom line per unit growth to slow this year, but there's good visibility into reacceleration next year.
Okay, let's talk about the valuation. How are things looking from that front?
Yeah, the valuations have picked up in recent months. We've had some M&A come into the REIT space, takeover activity with InterRent back in March. And then earlier this month, H&R announced a special committee in response to some bids it had received for some or all of the assets of that REIT. So it's clear that capital is coming back, and that is providing a boost of confidence, I think, for general investors to really take a fresh look at the space after many of them have been on the sidelines, since 2021. So the valuations have picked up. We're looking at about a 15% discount to NAV currently on average across our coverage universe, which is up from the lows of maybe a 25% discount, but still less expensive than the historical average of a 7% discount. So we still got some room to grow, and we look for potentially some NAV growth reacceleration into next year if we get a combination of stable fundamentals, which is what we're looking for, and also some relief on the rate front, which could help bring cap rates down that would prompt higher asset values. And we've already started to see that happen.
Okay, so you talked about the M&A trend. Let's talk about some of the other trends that are playing out. And you say that we're seeing some green shoots for office REITs. Why don't you take us through that?
Sure, absolutely. So, our own bank, of course, last week, I think, announced a 4-day requirement starting in the fall. And this follows, several other large employers announcing 4-day minimums this year. 1 or 2 companies announcing 5-day, requirements in the office. So this is, you're getting into, better part of a complete reversal from those early days of COVID. And as these large employers are making these decisions to bring their staff back to the office, not exactly the way it was pre-COVID, but, let's say 80-90% of the way, it's still allowing for some flexibility. That requires a pretty full, capacity of office space that you need. And so these employers, some of them are actually scrambling now because they didn't realize that they were going to, reinforce a return to office this quickly or this heavily. And so some space users out there in Toronto are actually on the hunt for more space because they don't have enough to accommodate the staff that they have and want to bring back to the office this fall. So we have seen, I would say, a pickup in leasing activity focused currently on the best quality buildings. But I think the sort of acceleration in this return to office trend almost suggests that leasing strength likely starts to spread to, maybe other locations or other levels of quality within the office market. So that's what we're increasingly optimistic about going forward.
Okay, so some green shoots in the office space. On the other hand, apartment REITs are coming under some pressures. What's playing out there?
Yeah, the pressure really is a result of the population growth slowdown that was really initiated last fall, and then some new supply that's really coming into the market, and that was kind of well underway heading into last fall. And still those deliveries are coming online. So this year is a pretty big delivery year. Next year is slowing down. So we've got a bit of a mismatch between the growth in demand and supply, but demand is still growing. And so, certain parts of the country have seen market rents slip. The good news is that the rate of slippage in those market rents has started to decelerate and flatten out. And so we're seeing increasing visibility on the prospect for market rents to stabilize and eventually grow. And I want to be clear that just because the market rents might have come down in certain parts of the country, it doesn't mean the apartments themselves are seeing lower rents that they're collecting every month. The rent, there's still a pretty big mark-to-market upside from the in-place to the market rent. And so, most apartment portfolios are still seeing growing cash flows even as we speak.
Okay, let's talk about tariffs because we're in the middle of earnings season when we've heard some companies talking about the impact of tariffs on the business. Is that impact of tariffs being felt on the REIT market?
Yeah, really, the main sector it's impacted is the industrial space, and that's where, warehousing, transportation, logistics, there's been some uncertainty, as you could imagine, in that space. And so a lot of the space users have really just hit the pause button on leasing decisions, and we really saw that in the second quarter stats that came out from the various brokers, leasing brokers. And so, the absorption has really slowed down. We're seeing supply also slow down. But ultimately, the trade war is going to end. There's going to be some new reality in terms of trade, the way it's sort of structured around the world and within Canada and North America. And there is some pent-up demand. And we're already starting to see, I don't want to use the word green shoots, but there's already been some resurgence in leasing. I'd point out Granite REIT, one of the names we cover. They've actually leased about 1 million square feet just in the last month or so. And that's a big acceleration for them in the last couple of years.